We got some committee moves. Josh, you're buying some more Shake Shack.
Yeah, they reported a great quarter. The problem is the stock's up 100% going into the print from the April low. It was literally 72 and ran to almost 150. So today it's giving back some. But when you actually look at the numbers, they were really fantastic. And Rob Lynch is doing everything that this company brought him in to do. Earnings were 44 cents per share, which beat the analyst consensus. Revenue was $356.5 million. That was above consensus. That's up 12.6% year over year. Same Shack sales were up almost 2% year over year. System-wide sales up almost 14%. And restaurant level profit, which I think is one of the key numbers for a company like this, hit $82.2 million, which represented almost 24% of Shack sales. They say Shack, not store. But the key thing here is the expansion plans are well underway. Margins are improving both at the corporate level and at the store level. And everything that they laid out as their goals when Rob came into the company, they're either on schedule or ahead of schedule. And as a result of that, I'm going to remain a long-term shareholder. Anytime a stock comes down 19% for no reason, for me, I have to add. So that's what I did this morning. It's already looking like a smart decision.
All right, Shake Shack shares pulling back about 13.5% right now.
Shake Shack just delivered a strong quarter. Earnings came in at 44 cents per share, beating expectations. Revenue was $356.5 million, up 12.6% year over year. Same Shack sales rose nearly 2%, and system-wide sales were up almost 14%. Most importantly, restaurant-level profit hit $82.2 million, nearly 24% of Shack sales. CEO Rob Lynch is executing well. Margins are improving, expansion plans are on track or ahead, and the company is delivering on its stated goals. Yes, the stock had doubled from its April lows, so a pullback was expected. But a 19% drop on no real negative news? That's an opportunity, and that's why I added to my position.
Over to you, a stock that's actually down year to date, PayPal, and you're selling right here.
Yeah, they had a decent earnings. Stock's off, 20% or something year to date at this point. I initially bought it just on the expectation that Alex Chris, I think he was in the job for about a year already when I bought the stock, and I figured he'd figure out a way to squeeze some juice out of the Venmo product. It's very rare that a company manages to jump from proper noun to a verb, and Venmo's in that rarefied air. But they just haven't really figured out a way to do that. Everything's been focused on like click to pay and branded checkout, and that just doesn't really excite me as a shareholder. There's a number of other fintechs that I could own, I do own, and so I just decided it's probably time to pull the plug here, spend those dollars elsewhere.
You just can't get people to pay for Venmo is the bottom. Like they try to do pay by Venmo where the vendor, like the e-commerce site, they would pay them something. There's very little uptake on it. And peer-to-peer, nobody's going to pay for that because Zelle is free.
Call it Venmo.ai, and then we'll start to...
I'm selling PayPal. The stock is down about 20% year to date. I originally bought in hoping CEO Alex Chris would unlock more value from Venmo, one of the few products that became a verb. But nearly a year in, there's been little progress. The focus has shifted to click to pay and branded checkout, initiatives that don't excite me as a shareholder. Venmo monetization hasn't materialized, and uptake on Pay with Venmo remains low. There are better fintech opportunities out there, and I've decided to reallocate my capital.
To get to very quickly, Bill, you're trying to play some of these trade deals with Cheniere.
Yeah, sure. So you have a trade deal with the EU, and we sold Cheniere a couple months ago, kind of with a lot of uncertainty surrounding what was happening around the April tariff announcement. We have a trade deal with the EU, and Trump is really aligning these deals with investments in the U.S. as well as energy. And if we're going to start to see energy being, the EU committing to energy, there's no one really in a better place right now than it comes to somebody that's exporting LNG. And these terminals take years to really implement. So I think what we're also seeing is sanctions on Russia. We're going to really see a need for LNG imports from the U.S. into the EU. I think Cheniere is very well positioned for that.
All right, Cheniere shares up just about 1.5% right now.
We sold Cheniere a few months back due to tariff-related uncertainty. But now, with a trade deal in place between the U.S. and EU, and Trump aligning those deals with U.S. energy investment, Cheniere stands to benefit. The EU is committing to more LNG imports, especially with sanctions on Russia. And with long lead times for building LNG infrastructure, Cheniere is already well positioned as a leading exporter. The setup looks increasingly